And let's move on to value. So value, how we define it is, or no, how the authors define it is that they divided the US stock market by book to market. Okay, so probably this requires a little bit of explanation. What do you mean by book to market? Okay, so most of us understand that usually one of the value metric is price to book ratio. Okay, price to book ratio. All right, so this book to market is actually the inverse. Okay, so you have the book on top, okay, which means book value divided by market. Actually, this market is divided by market cap. Okay, so this price is stock price, which is related to market cap, right? If you multiply by the number of shares. So price to book also, this book is book value per share. Okay, so this book here refers to the book value as a whole. So you take the book value of the company divided by the market cap is the inverse of price to book ratio. Okay, so they are equivalent in the inverse sense. Okay, so book to market for undervalued stocks. Okay, so that's how they define it. You have a top 30% of the stocks that's ranked by book to market versus the bottom 30%. So this top 30% will be known as the undervalued stock. Okay, so this top 30% will know as undervalued stocks, because if your book value is a lot higher than the market price, okay, it means that you're undervalued because the price is much lower than the book. Okay, so that's how you can read it. I know sometimes when it's inverse, it's a bit difficult to understand. Okay, so the difference is if you buy a basket of undervalued stocks versus a basket of growth stock. Okay, so the reverse of undervalued stocks, they label it as growth stocks. The difference is 4.8% per year. Okay, so if you are always buying low book to market or high price to book stocks, right, you are actually doing yourself some disservice, because you are actually getting lower returns. Okay. So what I learned about value, and this is something extra that I picked up, okay, because myself and some of us are value investors, so we are quite familiar with this value concept. So one thing that I picked up myself is that about the robustness of the metric itself, factor itself, because it can express value into these metrics. Okay, book to market is the one that we discovered just now. So you can use earnings to price, cash flow to price, whichever works, right? There's just a different way of expressing value. Okay, and don't be too concerned about, oh wow, I think that I should use cash flow to price because it give me higher returns. This is market dependent, depending on what cycle you are in. We cannot determine and say that one metric is better than the other. Okay, it's just a general sense that they all work because they are exposures to value in a different way. But that it doesn't tell us that this return over this metric is better than the other. So don't get the wrong message, because for all you know, different market cycle, book to market might do better than cash flow to price. Okay, so it depends. So we don't want to over optimize certain things at this point in time.